Hey everyone, welcome back to the channel. If you're new here, hit that subscribe button and turn on notifications so you don't miss out on the latest breakdowns in precious metals, commodities, and market trends. Today, we're diving deep into one of the wildest stories in the markets right now: why silver crashed a staggering 40% in February 2026. I'm talking about a metal that skyrocketed to an all-time high of over $121 per troy ounce just a couple of weeks ago, only to plummet to around $64, erasing billions in value in what felt like the blink of an eye. But this isn't just a tale of doom and gloom. There's a rebound happening, with silver now sitting at about $78.52 per ounce as of February 8, 2026, based on the latest spot prices from reliable sources like JM Bullion. We'll unpack the real story behind the drop, backed by fresh data from market analysts, trading platforms, and economic reports. I'll explain the key drivers step by step, what the data tells us about where we are now, and crucially, what could happen next. Will silver bounce back to triple digits, or are we headed for more pain? Stick around, because by the end of this video, you'll have a clear picture of the potential directions this market could take. Let's start at the beginning to set the stage. Silver didn't just wake up one day and decide to crash. This drama has been building since late 2025, when precious metals started their epic rally. Remember, silver closed out 2025 with gains of over 150% for the year, driven by a perfect storm of factors. Industrial demand was exploding. Think solar panels, electronics, electric vehicles, and AI infrastructure. The Silver Institute reported that industrial use accounts for about 50 to 55% of global silver demand, and with the push toward green energy and tech advancements, manufacturers were stockpiling like never before. Geopolitical tensions added fuel to the fire. The U.S. capture of Venezuela's Nicolas Maduro, escalating issues with Iran, and even prisoner swaps between Russia and Ukraine made investors flock to safe haven assets. On top of that, the U.S. dollar was weakening, interest rates were being cut, and there were real concerns about the Federal Reserve's independence under President Trump's second term. Trump repeatedly criticized Fed Chair Jerome Powell, and the Justice Department even launched an investigation into whether Powell misled Congress about Fed renovations. All this uncertainty pushed silver from under $35 per ounce at the start of 2025 to breaching $120 by late January 2026. Data from Trading Economics shows silver hit its peak of $121.64 on January 29, 2026. That's a mind-blowing tripling in value from mid-2025 levels. But here's where things get interesting, and where the crash seeds were planted. This rally wasn't just organic demand, it was supercharged by speculation. Futures markets were flooded with leveraged bets. Traders piled in, using borrowed money to amplify their positions. The Commodity Futures Trading Commission data revealed record-high speculative net long positions in silver futures, meaning everyone was betting big on prices going even higher. Volatility spiked to levels not seen since 1980, as noted by analysts at Standard Chartered. Silver's market is smaller and less liquid than gold's, so these swings get exaggerated. Gold rose too, surpassing $5,600, but silver's beta, its sensitivity to market moves, was off the charts, leading to outsized gains, and eventually, outsized losses. Now fast forward to early February. The crash kicked off around February 1, but the real bloodbath hit on February 5th and 6th. Spot silver tumbled from around $89.53 on February 4 to a low of $65.12 on February 6th, according to Yahoo Finance historical data. That's a drop of over 27% in just 2 days, contributing to the overall 40% plunge from the January peak. Combined with gold's 9 to 10% drop, the precious metals sector shed roughly $7 trillion in market value in a single session, as per Morningstar reports. Why did this happen? It's not one villain. It's a chain reaction of events that exposed the market's vulnerabilities. First up, the Warsh Shock. On January 30th, President Trump nominated Kevin Warsh as the next Fed chair. Warsh is known as a monetary hawk. He's advocated for central bank independence and warned against inflation risks. Markets interpreted this as a signal for potentially higher interest rates, or at least a slower pace of cuts. The U.S. dollar index jumped to a 2-week high, around 97.80, making dollar-denominated commodities like silver more expensive for foreign buyers. Al Jazeera and Forbes both highlighted how this nomination calmed fears about Fed interference, but crushed precious metals. Investors who had piled into silver as a hedge against a weak dollar and low rates suddenly reversed course. As the dollar strengthened, silver's appeal as a safe haven dimmed. Data from the Economic Times shows silver fell 4.2% to $68.19 on one day alone due to this dollar rally and equity market losses prompting liquidations. But the nomination was just the spark. The real accelerant was the mechanics of the futures market. The Chicago Mercantile Exchange, CME, hiked margin requirements 6 times in under 2 months, pushing them from 15% to 18% for silver futures. Why? To curb excessive speculation and reduce systemic risk. Each hike meant traders needed more cash to hold positions, forcing many leveraged players, especially retail investors and hedge funds, to sell off holdings to meet margin calls. Kavut's analysis calls this a systemic liquidity rupture. Stop-loss orders triggered in waves, creating a cascading sell-off. Suki Cooper from Standard Chartered noted that both metals were in aggressively overbought territory, so once profit-taking started, it snowballed. Trading Key reported over $30 billion in liquidations on February 5th alone, with silver's thin liquidity amplifying the pain. Unlike gold, which has deeper institutional backing, silver's market is more prone to these violent swings because of its dual role as an industrial metal and speculative play. Geopolitical de-escalation played a part too. Early February saw some easing in tensions. U.S.-China talks progressed, and the Russia-Ukraine prisoner swaps suggested a thaw. This reduced the fear premium that had driven safe haven buying. Plus, industrial demand softened slightly. Bloomberg and IndMoney pointed out that solar manufacturers, who account for about 15% of silver demand, slowed purchases after heavy stocking in 2025. Electronics forecasts weakened amid slower global growth, and supply chain improvements reduced the urgency for spot buys. While mine output remains constrained, the Silver Institute projects a supply deficit for 2026. The immediate pressure came from paper markets, not physical shortages. Let's look at the daily price action and make this concrete. From historical charts on trading economics and USA Gold. On February 1, silver closed at $79.28, down $5.12. February 3, $84.63, down another 48 cents. February 4, up to $89.53 with a $1.45 gain, teasing a recovery. Then the hammer fell. February 5th, down to around $67.39, a $3.51 drop. February 6th, rebounded to $77.82, up $6.93, showing some resilience. By February 7, it was at $77.73, and as of today, February 8th, a Sunday with markets closed, the spot price hovers at $78.52 per ounce, per JM Bullion's live update at 12:21 p.m. ET. That's a net change of about 10.13% from the lows, but still 35 to 40% off the peak. The gold-silver ratio, which measures how many ounces of silver by 1 ounce of gold, stands at around 64, up from historic lows during the rally, indicating silver underperformed gold in the crash. This volatility isn't new for silver veterans, but the scale is historic. Ned Davis Research notes that every time silver drops more than 20% from an all-time high, it takes about 7 years to bottom out and recover. We're seeing echoes of past crashes, like 1980 or 2011, where over-leveraged positions led to prolonged corrections. Yet, analysts like those at Morningstar argue this wasn't fundamentally driven. The bull case for silver remains intact due to structural tightness in supply and resilient demand from electrification and tech. So, where do we go from here? Let's talk about what could happen next and the potential directions for the silver market. In the short term, say the rest of February 2026, expect more whipsaws. CNBC reports tentative recovery signs, with silver up over 10% from its lows, but volatility could persist as markets digest Warsh's confirmation process and upcoming Fed decisions. JP Morgan forecasts a near-term floor between $75 to $80 per ounce, with potential recovery toward $90 if dollar strength eases. ChatGPT, in a fun AI prediction highlighted on Finbold and YouTube channels, sees silver between $75 to $90 by February 28th, with a bullish target of $86. That's based on balancing inflation expectations, rates, and demand. Looking broader into 2026, forecasts vary but lean bullish overall. Trading Economics projects $79.76 by Q1 end and $91.05 in 12 months. CoinCodex algorithms predict an end-of-year average around $129.40, with highs up to $266 in extreme scenarios, driven by ongoing supply deficits. UBS strategists view the sell-off as normal volatility in a structural uptrend, not the bull market's end. Industrial demand could surge if AI and solar investments accelerate. Reuters estimates a 2026 deficit of 200+ million ounces. Geopolitics remain a wild card. Any flare-up in Middle East tensions or trade wars could reignite safe haven flows. But there are downside risks. If Warsh pushes a hawkish agenda, keeping rates high and the dollar strong, silver could test $60 to $70, as per Investing.com's bearish scenario. Economic Times analysts warn of further corrections if equity markets falter, forcing more liquidations. GoldSilver.com notes rising margin requirements and deleveraging could ripple through, with crypto and stocks also in risk-off mode. Some YouTube jewelers and contrarians even predict a crash back to $50 to $60 if the rally proves purely speculative, not fundamentals-based. In a base case, I see silver stabilizing in the $70 to $90 range through mid-2026, then pushing higher toward $100 plus by year-end if demand holds. Bullish direction? Break above $90 could signal a return to $120 highs, especially with new 100-ounce futures contracts launching, potentially boosting liquidity. Bearish. A drop below $75 might open the door to $60, prolonging the correction for months. My advice? If you're an investor, consider physical silver for long-term holds. Coin shops are reporting backlogs, per reports. Avoid leverage unless you're experienced. Diversify. Keep silver to 5 to 10% of your portfolio. Whew, that was a lot, but I hope this breaks it down for you. If you found this helpful, like, comment your silver price prediction below, and share this video. What do you think? Bullish rebound or more downside? Let me know. Thanks for watching, and I'll see you in the next one. Peace out.